Welcome back. Welcome back. I'm Chauncey Williams, and this is WhatDoIDoNow.biz. And today's lesson is home financing lesson 4 on building that foundation in session 3. So we've been through about 3 lessons here, especially with this pictorial representation of me and my mentor, Tony Williams, farmers insurance agent and owner, business owner and investor. So the picture is basically the concept of when you save, you got to have a financial mentor that tells you where you put your money at, what you're going to do with your future. They are possibly in steps where you want to be, or they can show you to rise above them because you have them in space to help you strategically place your money in the correct places. So that's that pictorial representation of this actual concept and picture. It's not saying that I'm wealthy. I am, in knowledge, yes. And in finances, that's in the future. But the whole point is, are you building a future? So today talking about home financing lesson 4. So let's get right into that. Home financing, owning a home in lesson 4 usually ranks very high on American financial goals. In fact, most children will tell you exactly what kind of home they dream of even before they have a clue about a career goal. It is not surprising that nearly 65% of all Americans will eventually own their own home sometime in their lifetime. So it's going to happen, either you like it or not, whether it's going to be a land contract, a mortgage, somebody going to give you a property. You're going to have a time in your life where you're going to have access to ownership. Now, here are some key advantages to owning a home. First, you will build equity in your property, which you can eventually sell for profit. That means that you're going to have an actual bank account. A house is an asset. 2, you can deduct your mortgage insurance and your property taxes on your tax return. Yes, that can, but with these days and times, there's a limit on it. It's a cap on it, and the home has to be a certain value also. So that's check with your accountant. It's good to have an accountant, especially if you own a home. You may be eligible for tax deferment when you sell. So you can defer some of that income that you made off of that price of that home, off that interest, what you capitalize on. You will have additional space for less money. So you can have more home for less money, or you won't be getting charged for square foot because you paid it off or you found equity in it. You can borrow money from your home equity. Some people do that to start businesses, to pay for education, or to pay off debt. I don't recommend getting a second mortgage, but you got to figure a way out and figure if that's going to benefit you. You can change or alter or make payments improvements as you like to the home. That means you can add a roof, new windows, upgrades, new floors, and that can increase in the value. Spend $5,000, make $20,000 in equity. If it's in the right neighborhood, that's another issue there. It's an excellent investment as you'll be amassing wealth. So homes build wealth, mortgages build wealth. This is a good kind of debt. As we have described in the first volume, going into debt to purchase a home is usually a good debt. Purchasing a home through a mortgage allows you to use the bank's money to purchase property that hopefully will rise in value. So these are some of the advantages, because everything has advantages and disadvantages. So let's take a look at this example. So we got Mike and Tina beginning to look to purchase their starter home for 3 months after they were married. They had $30,000 to use as a down payment, which is a good number. That's great. They understand they could afford a $150,000 home. After a few weeks, they found a home that they both love. The seller was asking for $175,000 for their home and motivated to sell based on a recent job transfer. Although Mike and Tina knew the house was worth $175,000, they offered the seller $150,000 and were surprised the offer was accepted without the counter offer. They used $30,000 for the down payment and took out a mortgage for $120,000. Mike and Tina made some minor improvements, costing around $5,000, and moved to their first home together. After about 3 years, the teen was pregnant and a second child, and the couple felt like it was time for a larger home. They decided to attempt to sell their current home and began selling prices of comparable homes in their area. So they did comps. Comps are, if you got a house and you find the highest house in the neighborhood and the lowest, they average you out in that sector or in that region that you're in. And after having the home appraised and a meeting with the broker, the couple put their home on the market for $270,000. And it sold within 1 week of their full asking price. they had made a profit of $120,000 in 3 years and an initial investment of $35,000. And I think about this actual example as a client that I did have years ago, and I was amazed that they made $100,000 and they barely had the down payment to get in the home. And I was telling them, y'all don't have to put that much down, but look at that, times 4. Their down payment tripled times 4 as an investment. So that's how you got to look at it as a bank account. You go in with this $30,000. You do your due diligence when it comes to the demographics of the community and say, all right, this $30,000 is going to go here. In 4 years, this neighborhood is going to be worth this much. So when we sell, my initial $30,000 is going to be worth $120,000. That's $30,000 a year. I don't even know a stock market that does that. When you get 100%, 4 times, that's 400% in value that you increased on your original investment of $30,000. So if you look here, it's a breakdown. So it says, in this case, the debt worked in their favor. Should you continue to rent or you can afford to buy? This is a question we ask all ourselves. And it's an advantage and disadvantage to both. When you begin to consider purchasing a home, it is wise to carefully look at your finances and determine if your purchase is sensible. The first thing you need to consider is whether or not you have enough available cash to use as a down payment. Usually banks and lending institutions require 10 to 20% of the purchase price as a down payment. Next, you must determine if you will be able to finance the remaining price of the home. In general, banks and lenders will qualify buyers when their monthly housing expense is no more than 28% of the actual gross of the monthly income. So, as an example, you get a pre-approved letter because of your income is a certain amount and your score. But when they dig a lot deeper, they dig into that bank account, they dig into those tax records. They want to see things that go back at least 3 to 5 years where you got good investments, you got decent credit, and they do a credit pool within that 45 to 90-day closing. So to lock in the rate, so you don't want to be pulling for extra credit and things like that. So total income times 28, 4,000. So the total monthly housing expense is $1,120. This total monthly housing expense would include mortgage payments, taxes, and insurance. So that's not bad out of that actual income. So if they don't have other debts like car notes and things like that and other expenses, they should be fine. So before making a decision on whether to purchase or to continue renting, it would be very wise to contact a reputable mortgage lender and request a pre-approval amount. So like you'll run your credit score and they'll see what you qualify for based on your FICO score, all 3 credit scores. So they'll be able to determine your maximum lending amount among with the estimate of your monthly payments before taxes. With this amount, you can begin to shop for your homes in your area. Now, that don't mean that everything else together. They're going to ask for that bank account and all that other stuff. So a lot of times people get excited with a pre-approval letter. It just means you have a chance of getting a mortgage. But as the time goes on, you got to get everything together. Because the interest paid on the home mortgage is tax deductible, homeowners usually can take a substantial income tax savings at the purchase of the home. This deduction is obviously will reduce the monthly cost of owning a home and must be considered when deciding on buying a home. Let's take a few minutes to determine if buying is right for you. Because now look, some people buy and they be upside down on their mortgages, like car loans. Obviously, without evaluating each other's individual income, credit history, or down payment, it will be possible to determine the best scenario for you. However, we had developed a chart to assist you in determining the approximate monthly payments for a 15 and 30-year mortgages. Based on me, what I think, if I'm able to put 30% down, I could pay it off in 15 years. That's the mindset you want to have. Because if you pay an asset off like that in 15 years, just imagine what you can leave your legacy, your children, grandchildren. You got this bank account that they can invest in. And here's the chart. So monthly payment table. So here's an example. You find an interest that is applicable to you that fits your credit score and where you're at when it comes to percentage. The lower the interest, the better the credit score. So assuming you're a 15-year or 30-year mortgage, the number that's in the appropriate box is the number that you multiply by the loan potential. So here's an example. If you're looking at a rate of 8.5%, which is high right now because we're in a situation where we're in, we call it the pandemic. So that means interest rates are lower. We're seeing things at that 5% range or lower, which take a 30% loan, a 30-year loan. Then you can look at the number in the appropriate box, which is 7.69 hundredths times 7.69 hundredths, the loan amount of $200,000, and divided by 1,000, you get $1,538. and this mortgage amount for the next 30 years. All right. So often when buyers are considering the purchase of a home, they often overlook the additional financial responsibilities that are involved with owning real estate. So these are some terms that you look at when you get in that long sheet of paper and the read the fine print. It's so many pages when you go to the title company and close on a mortgage. You get a big old thick envelope with some. You might have a check in it for you. You might have to get them a check. You have your tax records there. When they closed, the mortgage, the insurance. If you got PMI insurance, you have enough down payment. If you got an FHA loan, so many riders and addendums to your loan that you need to learn the vocabulary. So home insurance, you will be required a proof of homeowners insurance to your mortgage lender to cover their entire mortgage amount. The insurance company may require that you cover be a minimum of your home's worth, believe about 80% of value to value, if that's correct. Property taxes, local property taxes, and school taxes vary dramatically between communities. Often it will be included in your monthly mortgage and means substantial increases in your monthly housing expenses. So a lot of times people put everything together and then they'll have a refund. But I don't look at a refund if you put too much money in. Keep on letting that money cycle so you can always caught up on your taxes. Because you don't want to lose your property because of taxes. Maintenance. Many homes are in subdivisions or associations, which charge yearly fees to all residents within the association or subdivision. Additionally, you are likely to incur expenses due to home repair and maintenance that should be anticipated. I always recommend being part of an association where they cut their grass, they do all the snow removal and things like that. And a reasonable amount for association will be $200 to $250. Anything above $200, $250 is ridiculous. I've seen associations charge $500. Unless you're a senior citizen and you want to live alone and you want to have this space where you got security. They do things like grocery amenities. Somebody come check on you, park your car for you. If you got that, yeah, it's higher. But on average, if you could do everything on your own, $200 is a number that I think that's reasonable for association fees. How to find the right mortgage that is right for you, that's a question. Because a lot of times people say 15-year, 30-year, I can do FHA, I only got 5% down, I got 3% down, or I got 30% down, or I want to do a loan where I buy a rehab property, fix it, build it up, then I sell it after I live in it for 3 years because it's because of my profession, they're going to give me a benefit of the doubt in 3 years because I'm living in this neighborhood that's have a demographic of high crime, but I'm a certain professional police officer, nurse, or teacher, and they give me the home 50% off, but I have to have to live in it 3 years before I move or before I sell it. So then you get the benefit if you could keep that property and you can follow those rules. So it's a lot of ways to look at it. If the mortgage is right for you, you got to look at the benefits for yourself. So you want either it's two kind of rates. You can have fixed rate or conventional mortgages. All right. So let's look at this. Mortgage has been around a long time, one of the greatest investments. These are the most traditional types of mortgages and have been available since the 1930s. A constant interest rate, the fixed rate, and other fees characterize these mortgages. With a fixed mortgage, the borrower can expect to pay the same monthly payment for the life of the loan. Never changes. If it's 15 years and it's locked, it's locked. If it's 30 years, it's locked. Additionally, fixed rate mortgages usually include points when the loan is originated, when it started. They're going to charge you up front what they think they're going to get. Usually, the points include the loan is originated. A point is 1% of the loan amount, which is due up front, usually at the time of closing. So that's what the top sign said. Bring a check for this much. That's what they mean. Your interest rate and points are related as your interest rate can be reduced over the life of the loan by paying upfront in the form of points. Therefore, you may consider points as another form of down payment as the advantages are the same. When you pay cash upfront, you enjoy the benefits of a lower interest rate over the life of the loan. That's why I say this. Cash is always king. It's better than credit. If you got a big bankroll and you could put it on that bank account, which I call a home, do it. I've been in cases where it's 3%. I've been in teacher next door. And the next home or condo we purchase, I'm going to try to have a large amount of money, possibly 30 to 40% of the funds, so I can go in and enjoy the lower interest rate, but that 15-year payoff, because if I pay it in so many years and I'm living in a certain area that's growing, I want that scenario that my clients had a while ago where they put that $30,000 down and they made $120,000 in the 3 or 4 year period. So they tripled their value of their original down payment. Something a bank account cannot do. Uh, arm rates. These are when the mortgage crisis happened in 2006 and 2007. That was not a pandemic, but it was a financial crisis, the bubble bust of the mortgages. So additional, but they can be investment prop. If you understand them and you're an investor, you can use them. Adjustable rate mortgages or ARMs is characterized by a varying interest rate and low initial interest rates. This works in your benefit when the interest rates are falling. So interest rates low right now, so an ARM will work for somebody because they'll get a lower payment. However, they can be costly in a climate when the interest rates are rising. So when we come out of this pandemic, you probably want to sell that property, but you can make a lot of money right now because the interest rates are low. Every ARM begins with an initial low teaser rate. So I might say 3 years, 2 years, 24 months. This helps to reduce your closing costs in the early months. Additionally, your interest rate will drop if the interest rates drop. So your particular one will drop if based on the ARM and the market. So this is based on actual markets. This is how they work. An ARM has a variable rate. That means it changes. It don't stay the same the whole time. However, your interest rate can only change on a regular schedule. So you got it set once a year. Where it goes on the market, it'll change. Your rate will change to reflect fluctuations in the cost of borrowing or the index. Your lender will determine your new rate based on two measures. So the index, the measuring of the interest rates of securities like U.S. Treasury. So that's that stock market stuff. The margin is hundreds of percentage points added to the index to determine your rate. So it's these two equations that come into hand that gives you your rate at a certain time period. So instead of having a fixed rate for the whole 15 years and 30 years, you have this market driving your payment, but it can go 2, 3, 12 months, 26 months, and you can set that number and then it comes. I recommend people when they plan those low teaser rates, always pay extra, always have extra. So then if you say, all right, I'm gonna keep this property and I want to get out of this ARM, I was in it 3 years, I got all this extra cash over here, I'm ready to pay this, and then I'm gonna go into a fixed rate mortgage. So it's not like I'm saving money. You actually are using it. So in case you want to buy it or you can sell it in that 3-year period, you'll be able to have that cash to catch up in that mortgage and and refinance and go into a fixed rate. So it's like that's the game you play. It's an investment. It's almost like you are using your property as not a gamble, but a smart investment. Cap costs. So all ARMs have caps or limits on the amount the interest rate can charge. An annual cap limits the rate change each year, with the lifetime cap limits the cap over the life of the loan. Beware of ARMs that allow the negative amortization. I've ran into one of these. This is when the borrower may owe money at the end of the loan if the interest rates above your lifetime cap. That's why I say had extra money. If you got this crazy thing where you got a house, I had a home that was about 2,500 square foot, and I was paying a mortgage payment of like $300, but it was an ARM. The smart thing I did was the regular payment was like $900. I kept on paying the 900, but I had it going in a separate bank account. So when the mortgage motorized, they said the payment was this much. What I did was I paid the payment when it doubled. It didn't triple. When it went to $700, I kept on paying it. And then I got in a situation where I refinanced it for 30 years. And I did that. And then the next year I sold it and I made a profit. I can't remember, like 10 grand, but I had to strategically say, I don't have extra money. This money is all going towards this event, which is my home loan. So I've been in that situation. The hybrid mortgages offer advantages of fixed rates and adjustable mortgages, so you can go back and forth. These loans may offer initial fixed rate with the option to change to lower the amount if one becomes available at the time. So it's like, oh, you can go from this amortization, you can go from this ARM in 2 years if your credit score is this. So then you can go from ARM to a fixed. And I did something like that, but it wasn't an actual hybrid. This product wasn't around at the time when I did it. It wasn't, at least it wasn't offered to me. So I did my own homework and found products like this. So it's amazing when you can find products like this. These are what investors do, or people that's not trying to live in a house for 30 years. They're like, look, I'm trying to make this money right quick. I'm going to stay in it, but I'm going to use it as an investment tool, and I'm going to sit on top of this money and I'm going to live in it. So the advantages, you will always know your housing costs. Your mortgage will not increase if the interest goes up. And disadvantages, initial rates and closing costs are higher. Your monthly payments may be larger. With an ARM, you will not benefit if the interest rates drop. So if they drop, it won't help. If they go up, you will. Advantages of the arm. I call them the arm because you don't know how strong it's going to be or how weak it's going to be. And that's what they call it, the adjustable. I call it the arm, like a real arm, the acronym. So you got advantages: low initial rates, teaser rates, reduce your closing costs. In early months, your initial rate will drop if the interest rate goes down. Disadvantages: interest rate increases. You may not have the benefit of a low locked rate. It's going to change. It's going to fluctuate. Choosing the right mortgage, purchase of a home is often the largest investment of your life. You won't purchase a home every day. You won't purchase one every year. Some people purchase 2 or 3 at the auction when they purchase those salvage properties or rehab properties, and they do that for investments. It's wise to shop around for the best mortgage for you. Remember, it's essential to find a lender that you are comfortable with. That is imperative. Don't let somebody treat you like a number. I'm telling you, it's embarrassing. Who is also knowledgeable and highly recommended. Be sure to contact at least 3 lenders and comparatively shop your loan. Now, another thing's going to that equation. Don't let your credit score get pulled so many times. If you get a credit score, you know it going in, and they say, I got to pull it. Well, don't deal with them. Say, look, this was pulled. Y'all going to use this one. That say my score is here. Or let them do a soft pull. And they could do a soft pull from places like Experian.com and Credit Karma. Now, they say, oh, that's not a real credit score. Like, well, let's say this. We're going to go off of this until I'm ready. You prove to me that you're worthy enough to pull that real FICO score that's going to give me a hard inquiry on my credit report. Make them do their homework for you first before they be pulling credit reports and you getting hits on your credit. And it's an exercise. So this is fun. This is something that you can review when you go back through the actual lesson. There's 3 advantages of owning a home. What is an adjustable mortgage? That's that arm. What is a fixed rate mortgage? And what is a hybrid mortgage? And that was lesson 4. We'll come back in next week. We'll be investing, making your money work for you. Again, the picture of myself handing my money to my mentor, or he's directing me on how to do it. Thank you. I'm Chauncey Williams. This is What Do I Do Now? The website is WhatDoIDoNow.biz. Let's get our financial future and foundation together and set in place so we can make the changes to live the life we want to financially.